In recent weeks, the debate over President Trump's tariff policy has taken center stage, drawing immediate criticism from both market analysts and political observers alike. The implementation of these tariffs has coincided with a stark market downturn, as evidenced by significant declines in major indices such as the S&P 500, the Nasdaq, and the Dow Jones Industrial Average. This report delves into the unfolding economic realities, the contentious defenses of these measures by some Trump supporters, and the broader implications of such policies on the American economy. A recurring theme in the discourse is the attempt by Trump's loyalists to justify the imposition of tariffs, a stance that is rapidly met with public and expert skepticism. Critics argue that a political faction, once known for its selective concern over minor cost fluctuations, exemplified by the notorious focus on 10-cent changes in egg prices, now finds itself grappling with the ramifications of policies that have precipitated an economic downturn. As the market registers declines, the discussion has shifted from a debate about minor price adjustments to an acknowledgement of a deeper, systemic financial impact. Central to this debate is the semantics of market performance. Supporters of the tariff policy have attempted to mitigate concerns by contending that being down merely signifies a reduction in numbers rather than a catastrophic loss of value. This line of reasoning was exemplified in a commentary by media personality Will Cain, who, amid a national audience, sought to reframe the conversation about market declines. Cain's analysis, focusing on a 12-month chart of the Dow Jones Industrial Average, revealed that the index has effectively reverted to levels observed in October, levels that had been surpassed during the peaks of Trump's previous terms. This observation indicates that, from a historical perspective, the market has returned to a pre-Trump baseline, a point that critics argue underscores the failure of the policies to foster sustained economic growth. Further deepening the analysis, financial experts and publications have painted a sobering picture. Wall Street itself is characterizing the current downturn as a crisis, while notable economic voices, including The Economist, have labeled today as a day of potential ruin. Betting markets now suggest nearly a 50% chance of a recession, a prediction that, while inherently speculative, carries weight given the long-term structural shifts at play. This forecast emerges even as some analysts attempt to contextualize the downturn by zooming out on the time axis, thus presenting a more tempered view of the economic cycle. However, such an approach raises questions about the reliability of defending a policy whose immediate consequences are so tangible. The debate has further intensified on social media platforms, where a tweet, garnering nearly 8 million impressions, claimed that the S&P 500's 5-year performance had declined from a 135% increase to 118%. This selective use of data has been widely circulated by right-wing influencers and has served as a cornerstone for the argument that Trump's policies, in fact, laid the groundwork for economic recovery, despite evidence to the contrary. Alongside this, commentator Benny Johnson has provided a stark, almost nihilistic perspective, suggesting that the experience of financial loss, while costly, is an unavoidable and character-building aspect of life. Johnson's rhetoric, which dismisses the significance of monetary loss in favor of personal fortitude, starkly contrasts with the reality faced by millions of Americans whose retirement savings and investments have been dramatically eroded. In drawing a comparison between the economic legacies of the Trump and Biden administrations, the narrative becomes even more complex. Proponents of Trump's policies argue that his administration achieved unparalleled economic progress through aggressive measures such as reshoring supply chains, instituting broad tax cuts, and deregulating the marketplace. They contend that these actions were instrumental in restoring American economic might. In contrast, critics point to the record 16 million jobs added, historically low unemployment rates near 4%, and a stock market reaching record highs under the Biden administration. This juxtaposition creates a dichotomy where each side claims credit for an economic performance that, when examined closely, reveals significant trade-offs and underlying vulnerabilities. A critical examination of the tariffs themselves reveals a breadth of impact that extends well beyond abstract market indices. The new tariffs target a wide array of goods, ranging from footwear and clothing to electronics, sporting goods, toys, fresh produce, furniture, wine, spirits, cell phones, and automobiles. The immediate fallout was severe. The Dow Jones Industrial Average dropped by more than 1,000 points, the S&P 500 fell by over 3%, and the Nasdaq declined nearly 4.5%. These figures not only underscore the volatility introduced by the tariffs but also highlight a fundamental miscalculation in the understanding of international trade dynamics. Trade deficits, as some defenders argue, are merely accounting procedures with little bearing on the overall health of an economy. Yet, history has repeatedly shown that such shortcuts in policy can lead to significant market disruptions and long-lasting economic damage. The political ramifications of these developments have been profound. Among Republicans, there remains a fierce loyalty to Trump, often at the expense of acknowledging the tangible consequences of his policies. This unwavering support has led to comparisons with past political missteps, notably the infamous denial of any impropriety in President Clinton's personal life. The analogy is drawn to suggest that, much like the dismissal of scandalous claims in the past, there is now a reluctance to confront the economic realities brought about by Trump's tariff policy. Critics argue that this selective memory and partisan deflection serve only to obscure the immediate harm inflicted on everyday Americans. As the debate continues, it is important to recognize that the current environment is one in which the interplay of politics and economics is becoming increasingly inextricable. On one hand, there is a reliance on digital platforms to suppress dissenting views and control the narrative, a trend that has raised concerns about the long-term implications for free speech and media independence. On the other hand, there is an urgent need for an honest reckoning with policies that have demonstrably disrupted financial markets and jeopardized the savings of millions of citizens. In summation, the unfolding crisis surrounding Trump's tariff policy is emblematic of a larger struggle within American politics and economics. What began as an attempt to bolster domestic industry through aggressive protectionism has, in practice, led to significant market instability and the erosion of personal wealth. The evidence is clear. Major indices have plummeted, historical benchmarks have been reset, and the very fabric of economic confidence has been shaken. As debates rage on both in the halls of power and on social media, the fundamental question remains, what is the true cost of such policies, and who bears the burden of their consequences? This investigative report has sought to untangle the complex web of rhetoric, economic data, and partisan posturing that defines the current controversy. In doing so, it is clear that while some continue to defend the policies on ideological grounds, the objective reality of the market downturn cannot be ignored. The broader lesson here is one of accountability and the need for policies that prioritize long-term economic stability over short-term political gains. Only by acknowledging and addressing these challenges head-on can we hope to navigate the turbulent waters of modern economic policy and secure a more prosperous future for all Americans.